Hello and welcome back. My name is Josh, and you've tuned in for a special episode, I guess. Today I'm going to be talking crypto. So I have had a number of people request that I talk about crypto and whether I recommend it, what I think of it. So first off, right off the bat, I do own crypto. I have some Bitcoin, some Ethereum, as well as a couple other coins, Chainlink being a main one, and Solana. However, I do want to note I'm a believer in crypto, but I feel responsible to say, you know, it is a risky asset. Be aware of that. I am aware of that. I knew that when I invested money, it could go to zero, and it could. I still believe it could. I think it's a low likelihood, but there's a definite chance. So don't ever, again, this is just opinions, not advice, but don't ever wager something more than you're willing to lose, especially with crypto. So with that out of the way, let's get going. So I'm a crypto fan. I wouldn't call myself a huge crypto fan. I don't know the ins and outs of it like some people, but I have tried to understand the thesis, and that's what helped me invest in it. Um, and so I'm definitely a bull, which is why I own and continue to own, and I'm probably going to hold it for the next 20 years, I would say, because I really do believe in the long-term thesis. I think there's going to be lots of ups and downs, like there has been. Actually, maybe here I'll just show you. There's been some crazy ups and downs, 2000%, then down 70%, then, up another 70%, then down another, whatever it is, 50%, then up here just in the last year, up another 600%. This is just Bitcoin. Obviously some other ones have had more volatile, but there's been a ton of volatility in it, and I expect that to continue. If this is not for the weak of heart, if you can't handle 50% drawdowns, don't buy Bitcoin because there definitely could be 20, 30, 40% drawdowns in very short order. So I'm expecting that, but I'm really trying to take a long-term view with Bitcoin. So the reason why I've been putting off this video for so long is because it is a bit of a complex thing. With a stock, it's a very easy thesis to understand. With a stock, it's ownership in a business. Everyone understands a business. You can always use the analogy of a lemonade stand, but everyone either works for a company or, they understand what a business is and how they make money. Cryptocurrency, on the other hand, is a little harder to understand. And most people call it digital gold, or Bitcoin specifically digital gold. So maybe let's start with what is a cryptocurrency. A cryptocurrency is cryptocurrencies are basically it's a giant digital ledger. Accounting, you write whenever there's a debit or credit, you write, well, we sold a shirt, so you have one less shirt, but you brought in $10. So there's a debit and a credit. That's a ledger. It's a note of everything that's bought or sold, brought in, destroyed. Sometimes you have to destroy old food or whatever if you're a grocery store. So all the ins and outs in terms of cash and goods and services. That's basically what cryptocurrency is. It's a giant ledger of all the transactions that have happened, especially Bitcoin, where it says, this person has this much Bitcoin, and they want to send it to this person. Well, let's check the digital ledger. And the difference is with a normal ledger, you typically you might pay the bank to go and say, oh, does Josh have $50 in his account? Yep, he does. Okay, I'm now going to authorize that transaction. So you have to trust that the bank is going to be honest. Now, I think banks are pretty honest, but they do take a cut. That's why banks are huge companies. They're worth billions of dollars. Collectively, they're worth trillions because we rely on them to facilitate transactions because everyone needs a trusted third party. You can just imagine, in movies, there's always the drug deal, and it's like, I want the cocaine, you want the money, and it's always tense, and someone pulls a gun. If you had a trusted intermediary who you really could trust, that makes it easy. That's one of the things cryptocurrency solves, is it is automated trust. Because this is not trust in a person, it's trust in the cryptography that protects it. So how does that work? Basically, a bunch of computers run these complex uh, functions. This is specifically for Bitcoin, and the one who solves it first, basically they verify that all the transactions in the ledger are correct. And by solving that complex thing, they get the right to add a new transaction to the ledger. So they say, hey, this just happened. This person gave 20 Bitcoin to Josh, whatever it is. And then once that's in the ledger, all the other ones can check against it. And if there's something that seems off, because there's a bunch of different computers verifying this information, they'll say, sorry, that's not a correct thing. Josh doesn't actually have 20 Bitcoin. He's got half a Bitcoin, whatever it is. So they'll ixnay the transaction and it won't go in the ledger. So that's basically how it works, is rather than one central person verifying transactions, you have a bunch of different computers distributed. It's a distributed ledger because it's not really in one place. It's controlled by a bunch of different distributed computers. Yeah, there's I don't know how in depth we want to get to with the actual cryptocurrency, but there's something called the 51% attack. If you own 51% of the network, you could basically override everyone, just like in a stock. If you own the majority, you can kind of dictate how things go. So theoretically, if someone owned 51% of the cryptocurrency, or the mining power more accurately, they would be able to change the ledger, and that would kind of break it, but it'd be very tough. And the reason is because the amount of compute power you'd need to get 51% is extraordinary. Because Bitcoin's worth so much, more and more people want to mine Bitcoin. What is mining Bitcoin? Again, it's running these complex equations to solve that prove that the math is correct, which again verifies the blockchain. So because there's a high reward for solving that thing, you get a small reward in Bitcoin. That's worth money. And because of that, more and more people want to get into the system of mining. Because more and more people want to get into the system, it means it's harder and harder to control 51% of the compute power. So this is it's a mathematical thing, but it's kind of nice that, the more valuable Bitcoin is, the harder it is to kind of defeat it. And the fact, again, if it was easily defeatable, we'd probably see it by now. Bitcoin's market cap is worth, if you total the number of Bitcoin times the price, it'd be worth a ton of money, a shit ton. I don't even know, maybe $4 trillion. So there's a huge incentive for someone to try to crack this code, and no one's been able to do it. So to me, I find that that's very comforting, and I really do believe that it's not going to happen. So is it safe? I really do think it is. Now, there's other cryptocurrencies, and they all have different things. So the next biggest one is called Ethereum. What's Ethereum? Ethereum is a smart contract. So similarly, it's a ledger, but it has these it says, if this happens, then do this. So for an example, it's not just money, I give you $20. Maybe it's, hey, I make a bet with you. I bet the Raptors are going to make the playoffs this year. And you say, I don't think they are. I'm a Raptors fan, in case you couldn't tell. Go Raps. This is not real, don't worry. But it's a replica ring from their championship. Huge Raps fan. I think they're going to make the playoffs. You think they're not. So we make an agreement. Well, how do I know you're going to pay off? Well, if you made a smart contract on Ethereum, you could say, if the Raptors make the playoffs, Josh gets 10 Ethereum. And if I lose, I pay you 10 Ethereum. So that's how it works. And this contract will automatically execute when the thing you said happens. That way, again, you don't need, you could think of this as insurance. If my house burns down, you have to pay me. You don't have to trust the insurance company is actually going to pay you back. Again, the smart contract automatically does it. You don't have to trust the betting institution is going to hold your money, or the bank, so there's a lot of applications for smart contracts. You could see it as performance bonus or something like that. If I sell 100 of these, you owe me this. You don't have to say, oh, there's no disagreements anymore. Again, this is about trust. You're automating trust because it's digitally proven through a contract. Now, then people say, okay, you made the bet that the Raptors are going to win. How do you actually prove that the Raptors are going to win? Through the smart contract. Yeah, it's easy to understand that, if the Raptors win, the contract automatically says, or here, let's take a better one. I have insurance. I'm a farmer, and I have insurance that if it doesn't rain on my plot of land, I bought an insurance policy. There's no rain this year, so therefore I don't get any crops. I need money to sustain myself, so I buy insurance to protect against that, rain insurance. And I say it didn't rain on my crop of land, and so I want to be paid out for my insurance. Well, how do we actually know that rain didn't fall on my land? What if the organization, the counterparty who I made the insurance agreement with, what if they use their own weather data and they say, no, you know what, you're in Toronto and we saw it rain that day. So too bad, we're not paying you because we saw it rain. And I say, no, it rained in Toronto, but I'm just in the south side of Toronto. It didn't rain here. How do you agree on what the actual facts are? So there's another cryptocurrency I invest in called Chainlink. Chainlink is an oracle network. Now, what's an oracle? An oracle, like if you think of it in the legend sense, is someone who can see things that others can't. So it is a way of verifying data for smart contracts. So how it works is it basically asks a bunch of people, validators, to validate different information. Back to the Raptors example, it might say to 50 people who won last night's game. The Raptors are, they didn't play last night, so I'm just gonna say the Knicks. And they get consensus that way. And basically, there's risk if you lie and say, oh no, the wrong team won, and you're wrong. You can actually lose. You have to put something up. You have to stake some coins, I believe. And so you say, here's 20 Chainlink, and if I'm wrong, you can take that from me. So again, it incentivizes people to be honest because they're putting something at risk. And if you validate it and it's shown correct, you can get a small reward in the form of Chainlink. So again, this is rewarding people for validating properly. So it's a distributed way of validating information. So those are the top three holdings I have in terms of cryptocurrency, and you can see there's a theme. The first one, a lot of people say Bitcoin is digital gold. Ethereum is, some people call it digital oil. It's smart contracts. It's the lubricant that makes the digital economy or Web 3.0 work. And I'm a really big believer in Chainlink as well, because I really think that you need the data inputs. I think it's like a digital database to confirm and make sure that the contracts from Ethereum are validated. So if a lot of people are, if we actually look at Ethereum market cap, so it's worth $500 billion. If you believe in Ethereum, and it's the number two, so most people do, I really then do believe in Chainlink, because I think someone's going to have to validate the information on those smart contracts. One last thing to note, I mentioned it briefly, but staking. So there's two main ways of validating a network. There's proof of work and proof of stake. Proof of work is the one with Bitcoin, where a bunch of different computers compete to solve one problem, and the first one to solve it gets to add the new block to the blockchain. The other one is proof of stake. Proof of stake is you put a bunch of coins at stake, and you say, here's what I'm going to add this new block to the blockchain. Other people validate you. If they see you're wrong, then you lose what you've staked. So again, there's an incentive to be right and to not lie, because otherwise you'd lose a bunch of money. If you're right, though, they pay you a small fee. So the reason why a lot of companies like Ethereum used to be proof of work, which is what Bitcoin's on, and they're switching to proof of stake, is proof of stake is 99% more less energy intensive. Proof of work, again, you have thousands of computers around the world all running the same complex calculations to try to solve a problem. So, you have 100,000 computers all trying to do the same thing. With proof of stake, you might only have 10, and then you have another 100 validating that those 10 were right, because they're gonna be right, because otherwise they're gonna lose their staked coins. So because you're using far fewer computers are competing, they basically randomly select 10 computers out of the 100,000 in this example to be those to add the next block. So because fewer computers are running it, it's less energy intensive. That's why Bitcoin's so energy intensive, because you have these high capacity servers running complex calculations all the time. A new block is added to the blockchain every 10 minutes for Bitcoin. It's different for each cryptocurrency. So cryptocurrencies come in a number of different flavors. They're all very different, but the basic thing is it's a distributed ledger that keeps track of something, and they're each trying to solve something different. One might be trying to solve carbon offsets. One might be trying to solve, there's one called Brave, which is trying to solve digital privacy. So, when you're online, Facebook and Google are always tracking you. So they say, and there's the whole advertising economy, they say instead of that, we want to reward you with cryptocurrency for watching ads and giving up some of your privacy, and then you can reward websites you like by paying them in cryptocurrency, saying so it's almost like a Patreon for the web, where you're also rewarded for looking at ads. So it's a different take. It's interesting. I like the idea. I'm not sure I'm sold on it just because I think Google and Facebook have such a stronghold on it, but it's an interesting idea. So again, all of them are businesses. Most of these coins, some of them are not. Like a Shiba Inu, I'm not a believer in those because they serve no real purpose. They're not building out a project. They're more, hey, if people adopt it, if they get use, they're valued. I like to not look at it like that. That is Bitcoin, but I try to say, what is the use case behind it? Ethereum, I really do see that you could build businesses and apps, or dApps, they're called distributed applications on Ethereum. So what would that be? There's one that you can trade cryptocurrencies and stuff like that, and that's built on Ethereum. So it enables you. A lot of people are talking about the NFT boom. What's NFTs? Non-fungible tokens. Basically, it is each Bitcoin. There's, maximum there's ever going to be is 22 million. But one Bitcoin is the same as another Bitcoin. They're indistinguishable, right? It's like a dollar. A dollar is a dollar is a dollar is a dollar. They're no different. NFTs are each, again, they're non-fungible. It means you can't really, they're not equal to each other, basically. So, I'll take trading cards. Let's just say trading cards. They're all trading cards, but they're each worth different. They're each a little different, and therefore their value is different. So one Bitcoin is the same as another Bitcoin. Every Bitcoin is going to be worth the same as another Bitcoin, even though they might have different numbers. You can think of like a dollar bill that has um, a serial number on it. NFTs, each one is unique, and therefore they're going to trade for different values. So there's ones called CryptoPunks, if you've seen these. CryptoPunks. So they're little images that look like this. Here, let's look at them. And each one it's like a unique piece of art, and you can buy it. And basically, the NFT says you own this piece of art. So I could actually I could save this image right now, but I don't actually own the CryptoPunk itself. It's the CryptoPunk itself that has value. It's similar to, if you took a picture of the Mona Lisa and recreated it and printed it and put it at home, or like an Andy Warhol, right? An Andy Warhol is not painted. So if you got a image like this, an Andy Warhol, got it at home, it's not worth much. Why? Because it's not the original. What gives it value is the fact that it's the original. So NFTs enable you to authenticate that, this NFT, this image isn't the original. The original is verified via the blockchain. So someone owns this image. And just like anything, why is it valuable? Supply and demand. People think it has value and they want it, so therefore it has value. So that's what NFTs are. They are, right now, they're mainly like pieces of art that people trade online, little pieces of art, but they can be worth a ton because people want them. And they are built typically on either the Solana network or the Ethereum network. So again, there is a use case for this. Think about it as trading digital baseball cards. That is an application, so you can understand why Ethereum would be valuable. However, most of these operate on the supply and demand curve. So in other words, like Ethereum is building something of value, but Bitcoin, what does Bitcoin do? You could say there's value there. People call it a store of value, but I think a lot of these other coins, there's no real value. What's the value or use case behind Shiba Inu coin? There's not really much, in my opinion. It's just that there's demand. People think it's going to go up, and therefore they want it because they want to make money in the future, but I don't think there's actually a use case there. So that's been a bit of a primer on cryptocurrencies. I know it's a little all over the place, but this is why I was a little afraid to do this episode, is because cryptocurrency is a little complicated. It's a big world. It's scary. People have varying opinions on it. But this has been a bit of a primer. I'll go into another one in a little more depth about Bitcoin and kind of my thoughts. But hopefully this was helpful. Let me know what you think in the comment section below. Do you own any cryptocurrencies? If so, let me know which ones. Thanks so much for watching and have a great day.